Welcome to the Money Study Podcast with Jim Bishopp. In this podcast, we bring lessons on personal finance to life, helping you achieve the dignified retirement you deserve. Jim will guide you through practical financial strategies and tips to manage your money during your working life and through retirement. Now, on to the show.
Hello and welcome to the Money Study with Jim Bishopp. Jim, how are you today?
I am great, Eric. How are you, my friend?
I'm doing fantastic. I'm excited to get into it. I know that your brother's sitting right there with you, and we're continuing our three-part series on cash flow, correct?
Yep, that's exactly right. Yep, we did two prior, and then this is the third in the series.
All right, can you remind the audience what the first two were? If you're just joining us, you're going to want to go back and listen to those. These guys have a ton of information. But what were the first two out of this three-parter?
So the first was sort of giving some tips on understanding where your money is being spent, how to maybe go through a budget, look at where you're spending money, and trying to look for places to free that up, or places that you should be, that you're not spending intentionally on. And then number two was tools for budgeting. So we talked a lot about sort of putting buckets together for different purposes: a retirement bucket, a savings bucket, a vacation bucket, a disposable spending bucket, et cetera. And now we're going to talk about debt, how to get rid of it. Nasty debt.
Yeah, no, I think there's a lot of people in this country right now that need to learn how to get rid of debt, including the government. So if you got any tips for them, yeah.
That's a lesson they're not going to learn.
Besides raise taxes, that's not the answer we want to hear, but I know that's coming, right?
Rule number one is stop spending, for criminy sakes. Trillions are lots of dollars. Those are big numbers.
Yeah, big numbers that I've never seen before. So,
exactly.
All right, where do we start today with managing debt?
Well, maybe we should start by thinking about different kinds of debt, right? Some debt is better than others, and we kind of put it in three categories, right? For the most part, Steve?
Yeah, pretty much. So there's kind of your secured debt, which would be mortgage debt, right? It's secured by the value of the home that's there. There's also some secured debt that's a depreciating asset, usually, which are auto loans, those kinds of things. And then, in my opinion, the worst debt, which is revolving debt, credit cards, department store cards, those kinds of things.
Cash loans, whatever. Yep.
Right.
All right. So we're going to tackle these one at a time then?
Yeah, I think that makes sense. We sure can.
All right. So let's start with the worst one, right? I mean, I think a lot of people have credit cards, and that's an easy trap to fall into. Can we start there?
For sure. I mean, I don't know. I look at my own kids. I look at clients. I look at families that we know that have this kind of credit card debt. A lot of them are paying only the minimum payments. Some of them have really high interest rates. I don't think they ever give any real consideration to how long it'll take to pay that thing off and get out from under the bank's thumb. So we really think they're sort of the worst form of debt available, and should be a priority in picking them off and trying to get them handled.
Credit card debt's also the easiest kind of debt to get into, because there's not much on a credit card application to go get a credit card, right? I mean, they don't, a lot of times they don't even verify income. You write down, I make $500,000 a year. They say, okay, here's your credit card. You write down, you make $10,000 a year. They say, okay, here's your credit card. So it's pretty easy to fall in that trap and that instant gratification on credit cards and that kind of thing. Give me the merchandise, the dinner, the whatever it is, I'll pay it off at the end of the month. And it's pretty easy just to come at the end of the month and go, well, if I didn't do one of the first two with budgeting and the buckets of money, there's no disposable income to throw at it. And so that's how people get in big trouble with these things.
Steve, it's still pretty easy too for people to use a credit card now, right? I mean, it's almost sort of desensitizes you to the spending of money. In fact, to this day, you carry cash for that reason, right?
Yeah, absolutely. I mean, I do have credit cards, but the problem with credit cards is it's too easy, right? It's instant gratification. If I have to lay $60 out for dinner, 320s is different than one plastic credit card. It just feels different mentally and emotionally, I think. And that's where people get a lot of trouble with it. That said, credit cards are a pretty amazing tool if you use them right. Who else is going to give you a 30-day loan for free? No one, really. Plus, if you pay it off at the end of every month, they will give you free stuff, whether it's cash back or miles or what have you. So they're an amazing tool. The problem is most people don't use them properly, and that's why they can give out free stuff.
Yeah, I think it's real easy to, if you got $100 in your pocket and that's sort of your disposable income, and then $100 is gone, you got to go to the ATM or you can't buy it. A lot easier to keep track of what you spent than if you just keep slapping that credit card on the counter every time you walk into the store.
Yeah, I think for me and my history, when we first started out and I was making some pretty poor decisions, both my wife and I were, credit cards really blurred the line of want versus need.
Absolutely.
Right? Because if it's something that I wanted, I could justify it pretty quickly because I've got the card.
Right.
All of a sudden I need it.
And I forgot what I bought yesterday for another $100, and the day before that for $40, the day before that, you know what I mean? So it's like, it's you just think about it from the moment to moment. In the cash flow part, episode number 2, we talked about buckets of money. So even if I'm using a credit card, I'm really using my debit card because I know how much is in that account every 2 weeks. And when that account, it's coming straight out of my discretionary spending account, and I know how much is in there, and I know when it's out, I'm done, right?
Yeah.
As opposed to a credit card where you got a whatever $20,000 limit. I don't know when it's done, nor do I care really.
Yeah, it's done when it's declined and you're at 20 grand, and that's the problem, right?
When the
All of a sudden you're
cashier's calling the
"Wait a
police.
second."
Yeah.
Yeah.
Oh
So,
my
okay,
God.
so let's tackle this one. How do you help people get out of credit card debt? What are some of the methods? I've heard different things like a snowball and other things. What do you guys tell your clients?
Generally speaking, kind of go a little bit against conventional wisdom, right? So if you have 2 or 3 credit cards, the pure financial answer is to pay off the one with the highest interest rate, right? So you got to know a little bit about your cards. That makes financial sense, but I also think from an emotional and making progress headway, I think it's best. I recommend that people pay off the credit card with the least amount of debt on it. So if you got a 2,000, a 4,000, 6,000, I start at the 2,000. Reason being is because people start to see success, and success breeds success. You start making an extra $1,500 payment on there. When that card goes away, they feel like they've accomplished something. If you start on the $8,000, $10,000 card, it's going to take you twice, 3 times as long. So that gratification comes back, and then I kind of move up the food chain that way as far as which one of those to pay first.
Yeah, and then when you pay that smallest one off, you take that $100 you were paying on that smallest one. Now you're applying it to the next largest one. Now you're making bigger payments. That feels pretty good too. So really, there's 2 strategies. One is to pay off the smallest one first, or the other one is pay off the highest interest card first. Mathematically, pay off the highest interest rate card is probably the most effective, but I think people can stay on track with paying off the smallest one first. There is a calculator on our website, www.sji.us.com, that'll help you do that. You can plug in credit cards and it'll walk you through what if I pay off the smallest one first? How much difference in time is there? So it is a personal thing, but for most people, I think paying off that smallest one first makes the most sense and, gets the most ground covered.
I think one of the good things that's happening too with credit cards is on your monthly statements, they'll say up on the top, if you're carrying a balance, they'll say, look, if you make the minimum payment, it's going to take you X amount of years to pay off.
600 years.
Right. And so I think that's kind of a good thing that's come about. It's kind of an eye opener for a lot of people, like, whoa, making that $25 payment is really, with the 22% interest, is making no headway.
And Steve, what about interest rate on cards, right? I mean, do you think most people really understand and the consequence of 2 or 3% different in credit card rate?
No, I don't. I think that because they're credit cards, people say it's $5,000. If that's my limit, it's $5,000 of free money, if you will. So I don't think they pay a ton of attention to the interest rates. I don't know anymore. I know when me and my wife had credit card debt, you used to be able to call up the companies and negotiate better terms. And I don't know if they'll still do that or not. I haven't had to do it in a long time.
Well, and another strategy, even if they won't, it could be converting credit cards occasionally. If you're really diligent, right? Some people do this and they just end up with more credit cards and more debt. But sometimes credit card companies will offer a lower interest rate or a 0 interest rate for a 6-month deal, and you can transfer your balance and then can really make headway. If you've got a 0 interest rate card and putting the same amount at that card, you can really make some ground. So you can kind of play the game that way too.
You just got to be disciplined is what it sounds like.
Got to be disciplined.
Correct.
And I'll just tell you, most people are not. They fool themselves. And, I was going to buy an ATV the other day, right? I went in and the price was outrageous because they could get it. And the guy looks at me and goes, nope, we don't sell them based on price. Nobody cares. They want to know if they can make the payment. If they can make the payment, they'll buy it. They don't care what the price is. It's just sort of the mentality, man.
Yeah, absolutely.
Same with credit cards. So,
all right. So we've tackled that one. What's another one? I think it was loan or for automotive.
Anything that we think will depreciate in value, right? So, cars are probably the best example, I suppose. A car, the day you drive it off the lot, is worth a lot less than you paid for it. And so those loans are kind of tough because we see people that never get out from under them if they don't put any capital down on them, right? I mean, people are upside down on their auto loans all the time.
Yeah. And there is exceptions to that rule, obviously, and certain classic cars appreciate in value,
Right.
but for the most part, they don't. And the problem with cars is they're so expensive to buy, especially in this day and age, especially if you're trying to buy new, there's no chips. And so if you do have to finance a car or a depreciating asset, make sure you get something you can afford, right? I mean, just because you want the Ferrari, but you can't afford the $3,000 a month payments, probably means you shouldn't get the Ferrari. You got to get something that's within your budget. So, cars are a little hard to pay cash for.
And if you're thinking about the Ferrari because you make a payment, you should be thinking about the payment on a Ferrari. You shouldn't be thinking of a Ferrari at all, right? I mean, you better find something you can afford. And I'll tell you, in our family, and obviously we're a little older, and we're doing okay, but we can we don't buy new. We don't buy any new cars. We'll buy gently used cars because we don't have the depreciation on them.
Yeah, you don't take 100% of the depreciation.
Right.
Push that off on somebody else.
Yeah. And we keep and maintain our vehicles too. So all of our cars are paid off. And I know that's not realistic for everyone, but one of our cars is a 2008. So, we just keep maintaining it. It's a great car. It's, a nice car, and, we just keep them up.
Yeah.
Cars generally are terrible investments. They're not an investment. They're a terrible asset because they go down in value, and financing them with high credit rates or over a long period of time just is hurtful.
Yeah. Well, when you said depreciating assets, first thing I thought of was a boat.
Oh,
We've talked about boats before, but
yeah, right. Same type of thing, right? You
Yeah.
paying cash for a boat, or you're financing it, but it is a depreciating asset and it makes it rough.
I'm gussing that's a sore spot for you, Eric. So you're having a hard time explaining to your wife.
well, yeah, this is why I don't let her listen to your podcast, because I don't need her to know the truth. I need to find a boat like a classic car. It's going up in value, honey. Yeah, there's not many of those. So.
We can talk about this stuff. Doesn't mean we always believe every bit of it, right? I mean, we're not always impervious to this stuff either, or always have been. So
yeah. No, but that makes a lot of sense. So let's talk about how to tackle that. I mean, you said hopefully you can pay it off. Used is a good option, but is there a good way to, besides a large down payment, to tackle that kind of debt? If maybe you've got some credit card debt and you've got an auto loan, how do you balance which one you're going to do first?
To me, I'm paying off the credit card debt before the auto loan.
Every time.
Okay.
So the auto loan generally has an end date, right? So it's you finance it for 3, 4, 5, 6 years. Cost of cars now, they're probably going out past that now. But the end date is there. The interest charge on that is usually less unless you have absolutely bad credit. So if we're paying off one or the other, you're always taking the revolving debt, the credit card first. In almost 100% of the situations.
Right. And, we see young people who often are the worst offenders in this regard. They're trying to buy a car that's beyond their means. It's fancier than their neighbors. And man, I tell them, look, this is what I tell my kids too. Listen, buy a lesser car, buy it cash, go mow lawns, deliver newspapers, flip pizzas, do whatever you got to do. Buy a $3,000 car, save up some more money, sell a $3,000 car, put another $1,000 on the next car, and buy a $4,000 car, right?
Just step your way up.
Step your way up in cash, or as close to in cash as you can. And because cars are not status, man. They're just money sucks.
Modes of transportation.
Right.
A to B. That's right.
Yeah,
that's right.
Exactly right.
Status should be like, how much money you got in your savings account to defend against, unemployment or COVID virus or whatever the hell else jumps in your face, right?
Yeah.
Not what you're driving, man. So I just think as a society, we need to get off the idea that cars are status.
Well, on this next section, I'm actually surprised. Earlier today, I heard a statistic that 38% of all home buyers own their home outright right now. And that's way higher than I thought it was.
Higher than I thought it would be too.
Yeah. And a lot of that is, there's a lot of people over 65. So when you take the age 65 and older out of the equation, I think it drops down to about 28%, but that's higher than I thought it was.
Yeah, me too.
That own it outright, but that still leaves a good chunk of people that are paying that mortgage. And right now I know the interest rates are low. So what is your guys' advice on A, getting out of debt, and maybe B, taking advantage of some of the things that are going on right now with the housing market?
So look, I think in order of importance, paying off your mortgage, your housing debt is last, right? Generally speaking, it's a really low interest rate. You're getting able to deduct the interest you pay
tax deductible
for most people, which makes the money even cheaper. And again, it's got an end date on it. So unless you're in a position to start to hurry on it, you don't have to. If you are, or if you got a big raise or something, you may want to look at refining from a 30 to a 15 or something, cutting the years in half, increasing the payment, but you save a whole bunch of money as far as interest charges over the life of the loan. But I don't generally, unless everything else is paid for, recommend that you kind of start hurrying on your mortgage.
Right. I'm in the same boat. I wouldn't even put extra money on my mortgage unless I had no credit card debt and my vehicles were at least at a really low balance, if not paid off, and I was saving some for retirement. What about the refi market now too, Steve, right? I mean, well, one other thing about mortgages, the underlying security is not going down in value typically, right? Like a car, your value of your car is going down. Your house, we hope, not always, but we hope is, generally appreciating in value.
Yeah, true.
So I'm not upside down. I don't owe more than my house is worth, hopefully. In a car, that's really not uncommon. Car goes down so fast in value, especially if I bought some new fancy car, it's going down in value faster than the loan's going down, right? So to get rid of my car, I owe the bank 10 grand.
Yeah.
Yep.
Right. That's the big advantage that housing usually has, is that it's an appreciating asset. And so in theory, you're making money on it by paying it off.
Yeah. And then what about the refi option, right? Rates are pretty low. What do you say to clients about that?
Yeah. So, I mean, it depends on your current rate, right? So if you can go in and save a point or two on interest on the long run on a 30-year note, it may be well worth your money. It's something you got to put pen to paper to, but I think most people have probably already done it. But if you haven't refied in this environment, I would really look into it. If you're over, I don't even know what 30-year notes are at now.
3-ish.
3.25. If you're much higher than that, you may want to look into it because interest rates are going up. I think that's set in stone.
Right. And I think, most mortgages have some fees attached to them. So it has to be enough of a differential in interest rate savings to offset the fees. And I would ask, if I was going to go to a mortgage broker or mortgage person, I would ask them, hey, I want you to calculate how long my break even is here. I'm saving money on my interest rate, but I'm also paying fees. How long does it take in savings of interest payments until I make up those fees, and make your decision based on that?
Right.
Yeah.
Cash out mortgages are rough too. I see a lot of people do that, and then they just end up upside down or pinned on their mortgage forever, right? Maxed out because they keep taking cash out for a pool or carpet or whatever they're going to do. New car.
So that's one of the problems with houses and equity. I'd rather have equity in the house than not have equity in the house. But the only way you can spend your equity, there's two ways to spend the equity: is A, to sell the house, or B, take a loan against it. So be careful with home cash out refinances or HELOCs or any of that kind of stuff when you're trying to get cash out of your house. It's just another payment to you.
Right.
Yeah, and I think it's all the math, right? I mean, that's, you guys already stated this, but we checked into it, and then it worked out well for us. We had friends that when they did the math, it was they're going to have to stay in the home for probably 5.5 years to then start making that difference because it was a newer purchase, so on and so forth. Yep. So that really wasn't in their long-term plans. They didn't know in 5 years if they would be at that home, so it didn't make sense to refi at that point. So that makes a lot of sense. But I want to go back to something you said earlier, Jim, when it comes to what you pay on your house extra compared to your retirement savings, things like that. So what are you telling me? Is it better to look at the math and say, okay, if I have an extra $500 a month, I should be putting that into investments versus paying down the debt on the house? Are you saying that you think the investments would grow faster than the debt would go down on the houses? I mean, is it just kind of a balancing act?
Yeah.
It's a loaded question. Go ahead.
Yeah. You're trying to get me in trouble with our legal department. I can tell.
And what do you recommend? And what?
Yeah. I think that there is an argument to be made that you just made, which is that if you're first, let me just say there's no wrong answer, right? I mean, having equity in your house and paying off your mortgage is damn sure better than buying a Ferrari, right? Or using credit card debt. So
we can all agree on that. Yeah.
Yeah. So it's not frivolously use money to pay down your mortgage. Which is better? Well, in simplest terms, your mortgage is at a fairly low rate and the interest you pay on your mortgage is tax deductible, reducing and that's, I guess, not true for everybody. Some people take the standard deduction. Get some advice before you do anything. But if you're able to deduct your mortgage, that's further reducing the cost that you're paying on your house. So if you assume that your investment accounts can make more than the cost of your mortgage, then I put it in the investment accounts. Right. For me, and this is just me, and everybody has to make a decision for themselves with what's they're most comfortable with. I put it in my retirement accounts first, just because I feel like I can make a little more money on my retirement accounts than I can on cost savings on the mortgage. But again, no wrong answers. Some people just really want to be rid of that mortgage. And if you do, I get it. So you have to kind of ask yourself what feels best mathematically. Depends on your investments. No guarantees about investment returns. We never know, but I like the idea of saving in for retirement in advance. First.
I think the other piece to that puzzle is what you're comfortable with, right? If your goal is go into retirement and not have a mortgage payment, and that's going to make you happy and sleep better at night and pass the pillow test and those kinds of things, I don't think that's a bad way to go either.
Yeah.
Right.
So your personal situation, your personal feelings, and then if you don't care either way, then it comes down to the math, in my opinion.
Yeah. And I sometimes talk to people who say that to me, said, rather pay the mortgage off so I don't have it. Because the other idea would be that you got enough more money in your retirement account that you could generate income from it to pay your mortgage. And would that make you feel comfortable as well? So a lot to think about. I guess like everything we talk about on the show, Eric, you should probably get some advice, right? And call us if you want some help. We'll be happy to, walk through those pros and cons in your situation, because no one piece of advice fits everyone.
Right.
Yeah. Right. And that's what I love about you guys, is that you're open to that conversation. Too many times we see commercials or you see something online that says, well, this can work for you. You don't know me. You have no idea what my situation is.
True.
So I love that. Is there anything else that we need to cover today? I knew I threw a bunch of questions at you, but I wanted to make sure that you gave the audience everything that you got.
I was going to say, one of the things we advocate for too is, as you know, we work with people in the public sector, teachers, professors, firefighters. We think there's some benefit in them adding some money periodically to one of their retirement accounts through their employer or through an IRA or whatever the case is, whatever they have access to, even if it's small chunks, $25 a paycheck, $25 a month, whatever that is, just so you sort of learn some investment tactics so that when you paid all this other stuff off and you have more money you can throw at it, maybe you've been through a market loss and you know what that feels like. So when it happens again, when you're a little bigger, it's not catastrophic in your mind
and it creates good habits.
That's a fact.
Right. Of paying yourself first, right. Putting some money in there. And so I like that idea.
So put a few bucks in a retirement account if you can, just to get some experience. Get rid of that credit card debt as fast as you can. Use one of the strategies we've talked about. Maybe then start attack the auto debt or boat debt, or not picking on you personally. I'm just saying.
Come on now.
Work on that. We didn't touch on savings either. So having an emergency fund is pretty important too. So that might be in your priority for cash flow. But again, we can help you walk through all that stuff.
Yeah.
How to prioritize where to put it.
All right. Well, tell the audience where they can reach you.
Well, they can call our office, 520-326-6133. That's our Tucson office, but we have folks in Phoenix and Flagstaff and around the state. So happy to get you to the right advisor in your area. They can check out our website, www.sji.us.com. I guess they can send us an email, send it to me, J Bishop, BISHOPP @sji.us.com. But there are lots, we're not hard to find. Look us up on the web. All that stuff is there. Give us a call. We're happy to help.
Yeah, absolutely. Well, guys, again, it was a pleasure to be back with you again. It's been a little while, but I appreciate everything that you're doing for myself and the audience. You answer all my questions, and I give you some tough ones sometimes. I hope today was a little tougher, but I appreciate everything you're doing. So thank you so much. And of course, the last thank you goes to you, the listening audience. Thank you so much for tuning in and listening to the Money Study with Jim Bishop. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Jim comes out with a new podcast, it'll show up directly on your listening device. This makes it really easy to share these podcasts with your friends and family, and this is a great one. I mean, I think most of us, I'm sure the statistics would tell us that most of us have debt. Let's get that tackled. Again, thanks so much for listening today. For everyone at SJI Financial Services Incorporated, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Money Study Podcast. Click the subscribe button below to be notified when new episodes become available. The opinions expressed in this podcast are those of the speaker and/or the guest and may not necessarily reflect those held by Voya Financial Advisors. Comments concerning the past performance of monetary instruments, investment indexes, or international markets are not intended to be forward-looking and should not be viewed as an indication of future results. Investment advisor representative and registered representative of and securities and investment advisory services offered through Voya Financial Advisors, Inc., member SIPC. SJI Financial is not a subsidiary of nor controlled by Voya Financial Advisors.